Hello, everyone. Welcome to another edition of CoverRight's Financial Planning and Healthcare Series. I am your host, Josef Katz. I am here today with a special guest, Sheryl O'Connor, who is the CEO and co-founder of IncomeConductor. Welcome, Sheryl.
Well, thank you for having me. It's a pleasure.
Yeah, great to have you on the show. So I thought what we would do today is kind of go through a little bit of your background, general information about financial planning, and then dive into some of the issues related to healthcare and financial planning, who does what should be done, and that sort of thing. Mm-hmm. So before we get into the nuts and bolts, do me a favor and tell me a little bit about yourself, your business, how you got started, and kind of work that IncomeConductor does, and we can go from there.
All right. Well, I started in the financial services industry in the 90s, working for large insurance companies first as a software developer, and then eventually managing large strategic programs. In 2006, I founded an asset management firm, jumped into the entrepreneurial world with my husband and a partner. And during the 2008-2009 global market downturn, I was managing a TAMP, which is a turnkey asset management program, kind of a back office solution for financial advisors. And I became interested in the subject of retirement income because I saw so many people have to put off retirement or retire early due to job losses because of the market downturn. But I also noticed that many retirees whose accounts we were managing were not panicking and pulling out of the market. So after researching these accounts, I noticed that their advisors were all using a particular retirement income distribution strategy called time segmentation. And it was developed by Phil Levinsky, a certified financial planner who has worked with retirees for over 35 years.
Interesting. So you've worked in big financial services. Now you started your own. Mm-hmm. What are the kind of clients that you work with now? Are they financial advisors? Are they or direct to consumer? Who you're?
Yeah, so we're a B2B SaaS technology. Our clients are financial firms and advisors who want to differentiate themselves and grow their businesses quickly by focusing on this really exploding market of retirement income planning. I'm sure you've read the headlines with millions of baby boomers moving into retirement and younger people wanting a secure retirement. It's really one of the top opportunities in the marketplace today.
Interesting. So what's your point of view on financial planning? How does it differ from, the hundreds, if not hundreds of thousands of financial planners and advisors out there?
Well, I'm one of those natural planners, that type A. I spent years at large firms as a program and project manager. I have a degree in project management, and I truly believe the best way to achieve success in any endeavor is to have a good plan, implement it, and then manage it closely. I think it's even more critical in the area of retirement planning since there are so many aspects of retirement that people know nothing about up until the point when they think about retiring. Like Social Security. Yeah, it's like, all of a sudden this wave of new information hits them: Social Security, Medicare, longevity and inflation risk, and much more. It really is a whole new world to both clients and advisors.
And of course, then you have the really basic stuff of why you still own equities and you're retiring next year. Yeah. Right. That's a different story. Right. So if there was something, you started your business, so there must be something that you thought was broken in the financial planning industry. So tell us a little bit about your platform and why you built it, and how you hope to fix or change the industry.
Yeah, we really wanted to modernize the strategies and technologies that advisors use for planning and honestly bring it into the 21st century. Today, people are used to managing their own investments in their retirement plans, maybe using a robo-advisor. They're used to being engaged with technology, whether it's through social media or apps like online banking. And the way advisors do planning now was really built for clients that existed 20 or 30 years ago. You know, our customers have changed, our culture has changed, and technology and the strategies those technologies use should evolve as well. So IncomeConductor is built really to not only give clients a written, customized retirement income plan, it enables the advisor to engage the client in building the plan and testing out the impact of decisions in real time. It's graphically attractive, it's simplistic in its approach. Of course, you know, the underpinnings are very complex, but it's very intuitive for both the advisor and the client to work with. So this provides a lot of benefits. First of all, the client truly understands their income plan because they had a hand in building it. And while that's happening, the advisor has the opportunity to educate the client. We talk a lot about financial wellness and education right now. This is the perfect opportunity to educate the client along the way about the various risks and factors in retirement, like the implications of when to claim Social Security, the trade-offs of guaranteed versus growth products, and much more. And then IncomeConductor gives the client and the advisor information and analytics on how that plan is performing every single day of the year, and alerts the advisor about opportunities to protect the client's income along the way.
It's interesting, and I picked up on this from this conversation, but also when we spoke previously. Income is the key word that you speak about, and I have a couple of questions about that versus planning and financial and so forth. But let's jump into this conversation about financial planning for right now, and we'll make sure everyone gets a link to your site and has access to learn more about your platform, because it's definitely something financial planners should take a look at. It's interesting. You gave us a walkthrough at CoverRight a couple of weeks ago. So you had mentioned to us when you were talking to the team at CoverRight, about 80% of widows or widowers switch advisors when they lose their spouse. And so I'm just curious, talk to me a little bit about the process of planning. It's one thing if I sit down with an advisor and do my plan, but obviously if my spouse is not there, things can go awry very quickly. So shed some light on that.
Yeah, so, surveys show that 70 to 80% of widows change advisors within a year of their partner's or their spouse's death. And it's funny because there's a lot of talk in the, financial services about that wealth transfer, securing that wealth transfer. And they've concentrated on it as the transfer from the parents to the children. Well, very rarely does a couple die at the same time, unless they're in some sort of catastrophic plane crash or car accident. So there are actually two transfers that happen during that phase of the family life. First, the assets transfer to the surviving spouse, and then they transfer to the children. So if the advisor is not securing that first transfer, they're losing out on the second one, definitely.
So if I picked anything up from your description of the platform, it's an ability to build a relationship with the family or the people that you're building these plans for. So obviously incorporating all the relevant parties is key to success of the relationship, but also of the plan. Yeah,
absolutely. I think, the financial industry as a whole has been very male dominated. And finances in general have traditionally, culturally been the man's domain, although, it's funny because it's mainly the wife that oversees the household budget, right? those two cultural norms, I think, have contributed to wives being left out of these important conversations and decisions about the couple's finances, which really lead to a stronger bond between the advisor and the husband versus the wife. So when the husband dies, the wife doesn't have a strong relationship with the advisor, unfortunately. So they look elsewhere for someone who will support them and recognize them as an individual. So I think advisors need to insist, first of all, that both parties, both partners participate in meetings and mutually agree on decisions around their finances so that, typically it will be the husband who will die first. The longevity stats show that, married couples, the wife has a longer longevity typically. And advisors need to modify their communication styles. Women usually like to ask more questions, and they'll keep asking questions until they receive the information they need to feel comfortable. So advisors should encourage women to do that without making them feel timid or as if they're asking silly questions or they're ignorant. So they should engage them and keep responding and asking them questions back. And it's funny because chances are the husband has the same questions.
Just afraid to ask.
He's just afraid to ask for fear of looking ignorant, right?
Yeah. So, other than excluding a spouse or a partner from the conversation, what are some of the other big mistakes you've seen over the years in the financial planning process?
Well, I think advisors feel very comfortable with accumulation. They feel very comfortable with investing and, doing analysis on different instruments and different markets. So what's really hard for an advisor coming into this space is they have to realize that accumulation is an entirely different world than decumulation or distribution planning and management. People who are working and saving are seeking to maximize their returns with their savings, with their investments. And even through down market cycles, they have the luxury of buying into the market at lower prices and waiting for their investments to recover when the market goes back up. Retirees have neither one of those luxuries. They don't have the luxury of buying into a market low because they're not buying into the market at that point. And nor can they wait for the market to recover to resume their income distributions. They need a steady paycheck regardless of what the market is doing.
So you hit on the big question, which is tied to your name, right? The income strategy versus a wealth accumulation strategy. And I think you've answered part of this already, but maybe you could highlight, pros and cons of, these two approaches to planning and when and where they may be appropriate. And then we could just, explore that a little bit.
Yeah, so first, I think the advisor it's really important that they need to be on the same page with the client. So people going into retirement have to realize that the ROI, which was their goal in accumulation, which means return on investment, right, is totally redefined in retirement. Now that ROI goal in retirement stands for reliable, ongoing income. I'm
gonna have to borrow that.
Yeah, and they have to get out of this mindset of maximizing returns and taking unnecessary risk, and instead focus on using the right strategies to ensure they will receive a steady paycheck that they need throughout retirement. So this means having a strategy like IncomeConductor that addresses the specific risks in retirement. And it takes into account all the considerations of retirement in the planning process, like healthcare expenses, like Social Security, like long-term care, like longevity risk, and then helps them manage that plan throughout retirement specifically in order to meet their changing needs. Because over, a 20, 30, even 40-year retirement horizon, there are going to be a lot of changes. The market is going to go through its natural cycles. They may have unexpected needs that come up. So, it's one thing to create a good plan, but then you really have to have a system and a technology to help you manage your plan through those changes and give you data to make decisions on.
Of course, there's also inflation and
Mhm.
cost of living changes. So you mentioned healthcare. So let's turn to that direction, because that's obviously near and dear to the CoverRight team's heart. I read a stat, and I'm sure you have others, maybe you can confirm or elaborate on this, that 98% of financial professionals believe it's important to discuss healthcare with clients. However, only 17% of those professionals feel very confident in their ability to discuss the healthcare topic and conversation about planning for healthcare costs. So, A, what do you think about those stats? And B, how could the industry evolve to provide a more holistic approach to incorporate healthcare planning when people are thinking about their overall financial plan for retirement?
Yeah, that's a great question. I think the main issue here is that advisors, like all human beings, tend to shy away from uncomfortable personal conversations in business settings. And, when you're talking about healthcare expenses and longevity, you're basically asking the client, what are your major health conditions and how long do you think you'll live? Now,
hard questions for people to answer.
yeah, exactly. But these are critically important data in creating a viable plan. So what we've done is to kind of take the subjectivity out of that conversation and bring more objective, reliable data to it. So IncomeConductor integrates that data from a top institutional provider into our plan editor dynamically. So they get reliable data right there at their fingertips while they're working together to create their plan. And this starts the conversation about longevity risk and how the client will meet those healthcare expenses. It also has a significant impact on when they claim Social Security. So we also pull in data that optimizes that claiming strategy, but also offers alternative strategies. And this is, we found, is really a comfortable starting point for those hard conversations. But it also ensures that the advisor and the client can make decisions based on reliable data and not just best guesses.
Right. You mentioned people living longer, and obviously the longer you live, the more healthcare you're going to consume as an individual. Planning for that is sort of critical, especially as healthcare costs continue to rise, and cost of medical care and for anything just keeps going up, as everyone who has medical insurance or goes to a doctor knows.
Yeah, I mean, in recent surveys, individuals have cited healthcare expense as their number one concern. That may be due to COVID and the healthcare services they've had to tap into around the pandemic. But the fact is that, at least in the US, with our healthcare system, healthcare expenses can account for up to 30% of a retiree's budget.
And just to be clear, you're including anything out of pocket. So it's
Exactly.
Medicare, extra expenses that's not covered, which that's a big percentage when you're not.
That's a lot. So if you're ignoring that, or you're not including all of the data or reliable data, you can put your client's retirement income plan at significant risk, because that represents a significant amount of savings spent. And it should be planned for. It should be incorporated in the plan. And if not, there's a very high likelihood that the retiree savings will run out before they die. And honestly, studies show that the rising bankruptcy rate for retirees the number one reason is healthcare expenses.
That's an interesting stat. Scary, but interesting.
Yep,
I,
it's
I,
reality.
yeah, I did not know that. You think people going, bankrupt are younger, made some bad decisions, and you're saying they're elderly folks who ran out of money.
Mhm.
Scary, interesting, and important to know all at the same time. So we've covered a bunch of topics at a very obviously high level, for the nature of this conversation.
Mhm.
What are some practical tips? Maybe you have 3 or 4 or 5 practical tips that advisors can think about as they work with their clients for financial planning, and specifically as it relates to the healthcare question.
Yeah, I'd say first, don't avoid it. It represents too great a proportion of your client's expenses in retirement. So it really is, from a fiduciary standpoint, it really is sort of almost malpractice if you leave that conversation off the table. Second, ensure you include all healthcare expenses in the client's plan, not just the premium payments, but the projected out-of-pocket expenses too. And again, they're projected, but it's good to plan, for the worst, and reap the best. So make sure that your data comes from a reliable source, one that institutions rely on to create products and underwrite insurance with. Third, I think advisors must realize that longevity has an impact on all facets of the income plan, Social Security claiming, healthcare expenses. I think you mentioned before that somebody who's in perfect health and has a very long, they could live over 100, they're going to spend over 3 million in retirement base versus someone who is chronically ill, who may die much sooner, they're going to spend much less. So, those healthcare expenses are really tied to longevity, long-term care expenses, monthly cash flow, the surviving spouse, what's their budget going to look like once their partner passes. And if advisors are using these rules of thumb, like I know some advisors have said, I run all plans out to age 100. Well, we know a lot of people are not going to reach that, great milestone. So what they end up doing is they're depriving their clients of a much higher quality retirement and basically ensuring they die rich.
Right.
And what we should be doing in the 21st century, when we have the data available, is using it, incorporating it to ensure that each client can have the best retirement that they deserve.
I'll throw one more tip out there. They should take a look at your product and think about income versus accumulation. So,
yes,
it's great that you get someone to a certain dollar amount in their savings accounts, but understanding how to spend that and use it for the rest of their lives is probably super important. So I have one last question. What would you recommend advisors do in relations to starting that Medicare and healthcare conversation? So it's such an important piece of this, plan, 30% you said. So how should they go about that?
it is. And you guys know that better than anybody else, that Medicare is extremely complex. And it's one of the first decisions that people face concerning retirement, because, people are turning 65 and still working. So what do they do then? Or if they retire a little bit earlier, what do they do up until, that Medicare decision needs to be made? And honestly, advisors should not be expected to be Medicare specialists. There's just so much to know, and it's always changing. But they should have discussions with clients, years prior to age 65 about how impactful these decisions are. And then they should have trusted resources they can use, like your product, or refer clients to a technology or a group that can help them make those right Medicare choices for their particular situation, because everything is so customized when it comes to Medicare selections.
Yeah, and thanks for pointing out the CoverRight solution. Yeah, we do work with financial advisors and planners on their Medicare side of their business. So if someone's working with a client, we will sit there as the third seat, so to speak, or if they prefer to hand it off, we can hand it off and hand it back, however they want. And, we use our own platform to figure out what's the right mix of product to cover the Medicare question and help people understand, product A is going to cost you Y, product B is going to cost you Z, and, what's the right way to look at this, and, what kind of coverage you want. We also can help educate advisors. We have a learning platform. It's free to anyone to use, advisors or consumers. It's at learning.coverright.com. Videos, blog posts, podcasts, all sorts of content that people can consume, get questions, and our team is always available to help at hello@coverright.com. They can email and someone will get back to them.
Well, that could make all the difference for a client. I mean, because there are so many situations where, if the advisor is not educated, if the client is not educated, they can make some really bad mistakes, around HSA money or things like that as part of the income plan. So, we encourage our advisors to surround themselves with experts. The experts are usually a combination of human and technology, but it really is important because these are critical decisions, whether it's Medicare or, legal issues like wills, powers of attorney. It really is important that you get experts involved in the process right out of the gate.
Yeah, I mean, there are some decisions that, if not made correctly, could be very costly. Both, obviously on the planning side, but also just on the medical and healthcare side. And so we're always happy to have those conversations earlier than, rather than later, so people are prepared. I think what we see now in the marketplace is a lot of fear mongering and companies trying to sell a product versus offer a solution. And if you don't have time to make that decision, you just jump and react. It could sometimes be costly. So we try to, for us, the approach is much more consultative and helpful. We try to make sure people understand what they're about to do. And if they want to use us to fulfill those services, great. If not, we understand. So we're here to help. And, our goal is to make it a more transparent and seamless process and not scary and not convoluted and confusing, because sometimes the government does that to some of their programs.
Well, we have similar goals.
Well, Sheryl, I appreciate you taking some time today. I definitely recommend anyone who's in the financial planning space to check out your product, IncomeConductor. We'll make sure to include a link in the description here. And look forward to speaking to you again soon. Everyone else, appreciate you tuning in and listening to us talk about financial planning. If you have any questions for us, we will get back to you. Leave us a comment or send an email to hello@CoverRight. And if you want to get the little alerts every time these things go live, you just subscribe to our channel. Sheryl, have a great day. I appreciate your time.
You too. Thank you so much.
Bye.